Hello, everyone. Today is Thursday, October 27th. So, what do we got for you today? We got a fantastic room. We've got Eric Basmajian with us. But before we get into it, and we're going to get into it pretty quickly because Eric has a hard stop at 5 o'clock. The room, of course, can go on, but Eric has a hard stop at 5 o'clock. So, just the educational, useless factoids of the day. Three things. In 1978, God, it seems like it was yesterday, Anwar Sadat and Menachem Begin were given the Nobel Peace Prize. Time flies when you're having fun. That's 44 years ago. On October 27th, 1858, Teddy Roosevelt was born. And then on a really personal note, because I was and still am a big Boston Red Sox fan, on October 27th, 2004, the Boston Red Sox ended the curse of the Bambino. They won the World Series by defeating the St. Louis Cardinals, the first championship in 86 years. I actually went to games 1 and 2 of that series. They were in Boston. At any rate, we've got Eric Basmajian with us here today. He needs a little introduction. He's been in these rooms. He's on Twitter. He's a friend. He's proprietor of EPB Research, specializes in macroeconomic forecasts, and really like the way he thinks. And I urge everyone to follow Eric. And he put out a blurb the other day explaining how his process works. And also, I listened to, and actually, Eric, I did prepare for this. I listened to your podcast you were on the other day with, I can't remember who it was. So, without further ado, Eric, welcome. And there's a lot to talk about, a lot of moving parts right now. So, markets keep me on your toes, no?
Yeah, it certainly is. Thanks for having me, George. And been a big fan of your rooms over the past couple of months. I I put together a thread of like 16 or 17 charts. I sent it to you in a DM. I'm not sure if you can embed
Yeah,
the
yeah, Eric. Why don't you start talking while you're speaking? I'm gonna
sure.
throw those charts up into the nest. So,
Okay,
so
so
you go for it.
once you throw those up there, everyone can follow along. I've labeled them chart one, chart two. So Um, basically, what I do is I analyze business cycles. I believe the economy moves in a cyclical fashion, and I believe the cyclical accelerations and decelerations in the economy largely influence asset prices. Um, I have a structural or secular trends overlay, factors that are mostly influenced by things like debt and demographics. So those long-term secular forces certainly play into my analysis. But for the most part, what I spend most of my time on a day-to-day basis and speaking to clients with and writing to clients is about the shorter term, or what I call the cyclical trends in the economy. And to me, shorter term is something in the 6 to 18 month range. Um, so basically, what I do is I spend most of my time trying to define the trend in growth. I think it's important to have a concrete definition of what the trend actually is. And if you look at chart one, you can see that that is a coincident index of real growth. So, what that means is the economy is made up of income, consumption, production, and employment. And those four corners of the economy, as I call them, work together, they move in a cyclical fashion, and the aggregation of those four areas of the economy is the best definition of the real time trend in growth. It doesn't tell you what's going to happen 6 months from now, it just tells you what's happened in the economy as far as the reported data is concerned. So you can see in this first chart, chart one, this is a basket of income, industrial production, non-farm payrolls, employment level, which is another level of employment, real retail sales, and real consumption. So it's a very broad basket that is better than something like real GDP, which was reported today because it strips out some of the volatile elements like inventory and trade. It has the income side of the equation as well as the expenditure side of the equation. And the way that I look at these charts, what you can see here is I look at it basically in three ways. I say, is the direction of growth increasing or is the direction of growth decreasing? Is the level of growth above trend, defined here as the 10-year average, or is it below trend? And is the growth rate above zero, or is it below zero? So what we can see is that the growth rate in the economy has been decelerating since the spring of 2021, and we've fallen basically to our long-term trend line.
Eric,
So you,
if I just interrupt for 1 second,
yeah,
just so for everyone, just so you know, I just tested it myself. Not only is that first chart up there, but the thread is there. So if people just click on the thread, they'll be able to follow along. All your charts should be up there. Go ahead, Eric.
yeah, perfect. Thank you. So what you could see is that the economy is slowing down, but it's not in a recession. I know there was 2 negative quarters of GDP, but that's truthfully not the definition of a recession. That's why asset markets or the relative performance between assets are not responding like they would in a normal recession because we're not quite there yet. The second thing to notice in this chart is that we've had somewhat of a stabilization in growth over the last 4 months. You can see we've kind of oscillated or trended flat at 2.2, 1.9, 2.0, 1.9. That'll become important in a few moments. If you go over to chart 2, this would be another measure of coincident growth or something that's defining the trend. You could look at the average of the ISM Manufacturing and ISM Services Index. And what you can see is that the direction is falling. It's below the long-term trend line, which is the orange, but it's not below zero, which is the 50 expansion contraction line in this chart. So it's singing the same song as the coincident index, which is the growth rate in the economy is falling. It's either on trend or slightly below trend, but it's not quite recessionary yet. And what's even more important is over the last 4 months or last 3 months, you see that same stabilization that you saw in the previous coincident chart. So again, I would keep that in mind. If you move over to chart 3 shows the 4 corners of the economy graphed in isolation. So what's holding the economy up or what's holding the economy out of recession? Everybody knows on the top right is employment growing at a 3.3% rate, which is above the long-term average. But employment's actually not the strongest segment of the economy. It's actually production. Production's running at a 4% annualized rate, which is above the long-term average. And you have consumption and income that are decelerating and below their longer-term average. If you move on to chart 4, what you could see is that the consumer is hurting. The personal saving rate is falling quite low, burned through a lot of the excess savings. And if you look at income and consumption, 2 of those 4 corners, it's trending at less than 1%, basically recessionary. But production and employment is still extremely strong, running at 3.5%. If you go to chart 5, I graphed the spread between those 2 lines. So these 4 corners of the economy are supposed to work in unison, supposed to mostly track together. The average spread between them is about 0.5%. But what you can see here is that employment and production are outperforming income and consumption by one of the largest margins we've seen in the last 20 years. So it's unusual to see production and employment outperform by this much, which gives me reason to believe that it's not going to be sustained, given that lower consumption and lower income will have to pull down production and employment. Inflation, which is chart number 6, has come off of its peak based on the consumer price index. This is a 6-month annualized growth rate. Core inflation is hovering near its peak. And if you take the coincident index from chart 1 and you add the inflation rate, you get a nominal growth rate, which is graphed in chart number 7. So you can see nominal growth is not decelerating to the same extent as real growth. It's not on its long-term trend line. It's significantly above its trend line. So nominal growth is still quite elevated. And this significantly above trend level of nominal growth is what's allowed the Federal Reserve to get in a lot of really aggressive rate hikes, more rate hikes in a short period of time than I certainly thought was possible. So if you go to chart number 8, you could see the nominal growth index in green, the real growth index in black, and then the inflation rate in gray. And I want to focus on the green line, which is nominal, and the black line, which is real. So the reason that these cycles in growth and these cycles in inflation and nominal growth are really important is because asset prices respond quite closely to these trends. So if you go to chart number 9, what you can see is two performance ratios. Graphed in black is the ratio of IWM to TLT, which is small cap stocks to long-term bonds. And graphed in green is IWM to GLD, which is small cap stocks relative to gold. The black line, IWM to TLT, is one of many performance ratios that, in my view, represents the market's expectations of nominal growth. And IWM to GLD is one of many ratios that roughly tracks the market's expectations of real growth. So if you toggle between charts number 8 and charts number 9, you can see that the real growth index, IWM to GLD, has fallen, tracking the real growth coincident index lower, while the nominal index has stayed quite elevated. If you remember in the first couple slides, I talked about that stabilization and growth that occurred over the last 4 months. And if you look at chart number 9, IWM to GLD, which is the market's expectations of real growth, you can see that it's been declining, but it made a low in July, and it hasn't made another low since then. We've actually been holding at that level. If you go to chart number 10, which is the ratio of copper to gold, another one of many market performance ratios that resembles the trends in real growth. You can see we made a low in July, and we've been stabilizing at this level, mirroring what's been happening with coincident growth. So the million-dollar question here is, where do we go from here? Does growth continue to decelerate from here, falling below trend and ultimately below zero? In that case, the performance ratios that you're seeing, IWM to GLD, copper to gold, IWM to TLT, they should directionally fall and make new lows, tracking the coincident index making new lows. As of right now, the market is correctly trading on a stabilization in coincident growth. So almost done here, and then I'll take a breath and pass it back to you. So in order to get a reasonable guess of where these coincident trends are heading, I track leading indicators. I'm not going to spend too much time getting into the concept. We could do that maybe in a Q&A or something. But the first chart that I want to show here is chart 11. We know that the Federal Reserve has been raising interest rates and tightening monetary policy extremely aggressively. The first place and most direct place that monetary restraint filters through is interest rates across the whole economy. Mortgage rates, corporate rates, treasury rates, all different kinds of interest rates. So what this chart is showing is an 18-month rolling change in a blended basket of mortgage, corporate, and treasury rates, and it's inverted. So when the line is moving lower, that means that interest rate pressure in the economy is going up. And I do that so it resembles the economic cycle. And what you can see is that in the 1999 cycle, interest rates across the economy went up about 200 basis points, ended up leading to a recession. 2006 went up about 150 basis points. In the 2018 cycle, before the Powell pivot, only went up about 129 basis points. And you'll notice that it's taken less and less interest rate pressure over the last several cycles to create a recession. And that's, in my view, as a result of the increased indebtedness of the economy. Despite that fact, we've pushed interest rates on an 18-month rolling basis 378 basis points higher across the whole economy, interest, corporate, treasury. So it's impacting everybody. And that interest.
So we lose
Am I
Eric?
back now? Sorry, I had a call come in.
Yeah, I think we lost you for a
my
second,
phone on
Eric.
Do Not Disturb, but
Yeah. Rewind for 10
family
seconds,
members
Eric.
can get through. So going back, this is a chart that shows monetary tightening. So we've had 378 basis points of interest rate pressure pushed on the economy. It's obviously extraordinary given the levels of debt. And the magnitude of the move is important. The duration that the rates stay up is also important. But it's unambiguous that the economy is about to experience, or is in the process of experiencing, the largest interest rate shock since the 1980s. The first place that a monetary tightening or significant rise in interest rates impacts is the housing market, which is the next chart, chart number 12. This is a sentiment index of the housing market, survey of home builders. What you could see is the housing market is taking a pretty good beating here. with the index falling below 50, signaling that home builders are seeing negative trends. You could ignore the annotations in the chart just because I want to keep moving through it. Chart number 13 shows total volume of home sales. That's new and existing, down 31% from the peak. That resembles the summer of 2007, to give you context of when home sales were down that much. Chart number 14 shows the spread between 30-year and 2-year treasuries, which has inverted. You could use any interest rate spread you want. I picked 30s versus 2s for no particular reason. But the point I'm trying to articulate here is that when the Fed tightens policy and you see a significant rise in interest rates, and that interest rate increase significantly impacts activity in the housing market, and then you see the yield curve invert, that is a sequence of events that confirms that monetary restraint is deeply entrenched in the early part of the economic sequence. So that process right there gives me strong indication that the coincident index that I showed in the first several charts is going to continue decelerating. And given the magnitudes of the move that we're seeing in the early parts of this sequence, the declines over the next several months could be on the sharper side. The last three charts here, just to sort of reiterate everything I said with today's GDP numbers. If we look at chart number 15, it shows real GDP growth graphed on a 2-quarter basis. And what you could see is the growth rate is decelerating. We've fallen slightly below trend. We're not below zero, and the growth rate appears to have increased in Q3. However, if you look at consumption and investment, which makes up 89% of total real GDP, you see a very sharp deceleration from Q2 to Q3, almost negative, which means 89% of the economy is almost in recession. And the boost that we saw was from the volatile, non-cyclical components like government spending, inventory, and net trade. But if you look at the leading components of the economy, which would be our housing sector and our consumption of high-powered durable goods like autos, what you see is first that the growth rate peaked in the first quarter of 2021 compared to the second quarter of 2021, which gives confirmation that it's leading. Second is that the growth rate of these two high-powered sectors decelerated below trend in the summer of 2021 compared to chart number 15, which didn't decelerate below trend until January of 2022, and what we've contracted for the last 4 quarters. So the very high-powered cyclical leading sectors of the economy have contracted for the last 4 quarters. The monetary restraint is not letting up, which means that there's going to be more pressure on these leading sectors. And that's sort of a sequence that I go through, which would give me confidence to suggest that coincident indicators like consumption, income, employment, corporate earnings, all of those things are going to show their sharpest decelerations in the months ahead. And that would tell me that I should remain cautious of risk assets and overall have a defensive bias as I approach markets.
Wow, Eric, that was just phenomenal and really excellent that you had those slides ready so people could follow along in the nest. I'm sure we'll have a lot of questions from the audience, so I urge everyone to raise their hand. I know your time is limited, so you've got a hard stop at 5 o'clock. So let's just get into it. So let's go back to the beginning of the year. Think about what expectations were back then. The 10-year was around 1.5, I think, or something, give or take. Everyone has bought. It was a fully paid up member in the transitory school of thought. And people had the idea that, oh my God, if rates went up at all, like the economy couldn't take it and it was going to keel over into a recession. Well, it didn't quite play out like that. Not only did rates go up a lot more than anyone imagined, but inflation's proven to be much stickier than people thought. And also, I suspect that probably 99% of people, if you told them that rates were going to be where they are, if you told them in January, if you gave them today's Wall Street Journal in January, they'd say, well, the economy's got to be in a depression. I mean, it can't possibly happen. So I guess the question in all that for me is, how is it that rates have been able to go up as much as they have, and the economy's not already in a full-blown recession? Or is that just a function of monetary policy, Milton Friedman, call your office, acting with long and variable lags?
Yeah, I think that a lot of it is the last part, which is that monetary policy has long and variable lags. And if anyone's still able to go back to the thread that I was referring to. And if you look at the interest rate composite slide, which is chart 11, that has generally a 12-month lead time over broader coincident growth. So when you see a big spike in interest rates, you generally would see uh, economic activity slow down something like 12 months in the future. Well, we didn't really start to get very violent increases in interest rates until the beginning part of 2022. So with a normal 8 to 12 month lead time, that would suggest that it would be somewhere around the end of the year that those interest rate increases would impact coincident data. And I think that that's happening roughly according to schedule, given the fact that we're starting to see some of the nastier headlines leak into more of the consensus stories rather than just the early sectors like the housing market. There's a lot of discussions around the freight market and trucking and things like that. We're getting closer and closer to the coincident data. You're starting to see more earnings misses, more guide downs. Um, the second thing I would mention about inflation is that inflation lags growth. So while these leading indicators that I talk to have something like an 8 to 12 month lead time over coincident measures of growth, then there's another 6 to 8 months roughly until it impacts inflation. So if the Fed raises interest rates today, that's going to impact economic growth something like 8 to 12 months in the future and then impact inflation something like another 6 months after that. So you could have roughly an 18-month lead time before significant changes in inflation. So the fact that the Fed is raising interest rates sharply now and inflation's not coming down in the following print is not all that surprising. Um, the interest rate policy that we had in early 2020 and late 2021 uh, is influencing the inflation rate today, where the policy that we're having today is going to influence the inflation rate in the back half of 23 and early part of 24. And my guess is that the inflation rate is going to look significantly different when we get to that period and these lags are able to filter through.
So, Eric, let's stay with that. So, I think right now people are conceding that we're looking at a big economic slowdown. The debate is, are they in a recession or will soon be in a recession? Um, what informs you as to the depth and duration of the recession? If you look at, you know, uh, various sectors, whether it's inventory accumulation or the extent to which new car sales have been depressed because of lack of supply, or the extent to which housing, there's a lot of reasons to think it's going to be better or going to be worse, et cetera, et cetera, et cetera. But as you project forward, yes, okay, so we're going to get a recession. I don't think too many people would argue with that. But what informs you as to the duration and depth of any recession?
Mhm. So first thing is that it's always a rolling forecast because the leading indicators that I use and the best leading indicators that I know of can't see, a year and a half into the future. They're most accurate if you make something like a rolling 4 to 6 month forecast. So it's difficult to say uh, what the exact magnitude and duration is going to be because if it's going to last longer than 6 to 8 months from now, it's difficult to say that with any confidence. But you could 3, 4 months from now say it's going to last another six, right? So you could always make a rolling forecast. I think that's best. However, there are some indications that we can use to assess the likelihood of whether it's going to be a deeper recession or a more mild recession. The first thing is um, you can look at the rate of contraction in monetary aggregates or monetary policy. And on that basis, we're experiencing one of the most rapid contractions in monetary aggregates and overall monetary policy ever. You have to go back to 1980, 1981 to find a time where monetary policy was contracting at a similar rate. The only difference between now and then is debt levels are 200 percentage points higher. So the restraints actually likely to be even more intense. So the rate of contraction in monetary policy is the first thing that would give me an indication that we may be looking at something sharper than what the consensus believes or deeper than what the consensus believes. The second thing that to me is extremely important in determining the severity of a recession is the housing sector. One of the reasons that the 2000s recession was extremely mild is because it was one of the only recessions ever where you didn't get very significant declines in the housing market. And to me, that's one of the reasons why it was more mild. Downturns or recessions that are associated with very severe contractions in the housing market tend to be a little bit more painful. I'm very concerned about the housing market now because the housing market has softened. Well, soften's probably not the right word. Um, has slowed to a point where at any other time in history would require monetary easing or necessitate monetary easing. The Fed obviously can't do that at the moment because of inflation. Um, so they're going to be forced to continue tightening monetary policy at a time when the housing market desperately needs monetary easing. That's going to be problematic because by the time the Fed gets around to easing, which some people think maybe is at the end of this year, maybe is in the first quarter of next year, you're going to have a downturn in the housing market that's been ongoing for somewhere like 12 to 18 months. And it's not like the Fed is going to be able to cut interest rates and restart the housing market. It doesn't always work that way. The Fed cut interest rates in the summer of 2007 after pausing in the summer of 2006, and things didn't turn around right away. So, the second consideration that to me it could be a longer or deeper recession, with the caveat that I'll make rolling updates, is that the housing market is in a very bad position here, and it's unlikely to receive support in the next 3 to 4 months at a minimum, I would say. And that suggests that we're going to have, the pain that is being experienced in the housing market now is going to be somewhat commensurate with the pain experienced in the broader economy with some reasonable leads and lags.
Jeremy, can I interrupt, please? So let's just stay with housing for a second. So people say, well, it won't be as bad as the last cycle because we don't have the same excesses in the mortgage-backed securities market. Okay, fine. But there are other excesses. I don't know if you were in the room when we had Ivy Zellman a few months ago. She pointed out the fact that the first half of this year, fully 24% of transactions involved a non-primary buyer, whether it was build to rent or financial buyers like Blackstone buying properties or Airbnb. Basically, 24% of the demand was non-primary, extremely large number relative to past cycles. And when as long as number go up, fine, no problem. But when number go down, the hidden supply people can attempt to monetize that pretty quickly. So, and she made those comments to us back in I think June, July. Turned out to be right in spades. But looking ahead, and I know you look at the same data I do, you just look at housing affordability. It's the worst it's been in 40 years. I'm reminded of Steinzel. I tweeted something out along these lines a few weeks ago. That which can't go on won't. When you look at you probably have better numbers than I do, but the average payment, blah blah blah, has gone up. For the typical mortgage, it's gone up by 80 or 90% or whatever.
Right.
Affordability's gone off the charts, and so either prices got to come down a long ways or rates got to come down a long ways. And for the reasons you set out, unlikely going to see a huge decline in rates. So it kind of makes me think what we're going to be looking at a real housing debacle. What would your pushback be to that?
Yeah. So, on the point about excesses, I don't have too many examples where home prices rose at a 30% annualized rate nationally. So that's a little excessive, I would say, based on history. I sent you another DM of a thread that maybe you could embed that I'll walk through that'll give my take on what I believe is the most common pushback I see on the housing market and why it won't be bad. So from
Okay,
a
so Eric, it's up in the nest. Go for it.
Okay, great. So what I talk about here is the supply story because what we hear is that home prices can't fall because supply is too tight. But there's more nuance to what's going on in the supply of housing. So if you look at tweet number 2 in the thread, what I'm looking at here is the month supply of total U.S. housing. Anytime month supply, which is the number of months it would take to clear the existing lot of inventory at the current pace of sales. So month supply to me is the best measure because it encapsulates supply and demand in the same chart. So the month supply of total US housing is 4.1, which is extraordinarily tight. No debate about that. However, that number 4 of month supply is comprised of an existing home sales month supply figure that's 3, and a new home sales month supply figure, which was just reported yesterday, that rose to almost 10. So the month supply in the new home market is not tight, and it's actually the loosest it's been since the great financial crisis. But the existing market is extraordinarily tight because of this phenomenon that we're seeing with people unwilling to give up their mortgages at low rates. Problem is, new homes don't have that problem because no one's living there yet. So you have all these builders that have significant buildup of month supply of inventory and they can't move them. And if you go to the next chart in the thread, we have empirical confirmation that home builders, people acting in the new home market, are cutting prices to deal with this swelling in inventory. So in chart number 5, what I did is I ran a correlation between the month supply of total U.S. housing, the number that everybody refers to, and home price growth 6 months in the future. And sure enough, there's a reasonably strong correlation, which would suggest inventory's tight, home prices aren't going to fall. But if I run the same correlation with just existing homes versus the total, the correlation's a little weaker. And then in chart 7 in that thread, I run the correlation between the month supply of new homes only and home price growth of all homes going forward. And the strongest correlation is actually with the month supply of new homes, even though it's a smaller market. The reason I believe that to be true is because the builders or people transacting in the new home market are price setters. So if a home building company or a company that is speculating and builds a lot of homes that are all new is stuck with too much inventory, they're going to hit bids and move prices at levels that allow them to clear their inventory. And given that for a buyer, a new home and existing home are relatively close substitutes, I can't see an environment where new home prices fall 10 or 15%, and that doesn't drag the markdown on existing homes. So I think the supply story is a little convoluted, and once you get into the numbers, you realize that it's the existing market that's really tight, but the new home market is actually starting to get really loose with a month supply that's at a level that we haven't seen since GFC.
That's terrific, Eric. So let's generalize that a little bit. So clearly, the outlook for housing prices is not good. Stocks, bonds, we're in everything bear market right now. We all read the same stuff. There was something out the other day which I think suggested globally has been, I don't know, it was the U.S. or global, it's like a $40 trillion hit to wealth. How do you think about financial instability and increases and decreases in asset prices as it impacts the economy? I mean, Jeremy Stein, Harvard professor, was formerly a Fed advisor, member, whatever, wrote this whole thing about financial stability. And I got to think, I mean, you're already talking about, the impact that the big increase in rates is going to have on the economy. What about the massive wealth destruction we've seen? How do you think about that?
Yeah, so I really try and have most of my views supported with academic research. And the best academic research that I found on the wealth effect is that the wealth effect for the stock market is not all that strong. We had tremendous gains in the stock market from 2010 through 2020, and real consumption growth was anemic relative to history. So booms in the stock market don't always translate to increases in growth or consumption. But the research does suggest that the housing market has a stronger wealth effect than the stock market. And I think there's several reasons for that. One is that people perceive that the housing market is more stable than the stock market. The mark doesn't change every day on their house, but it changes on their portfolio. So they believe that if their home goes up 20% in value, they believe that's somewhat permanent. Second thing is it's more common to borrow against your house, maybe a home equity line of credit, borrow for consumption than it is to borrow against your stock portfolio. Most normal people don't borrow against their stock portfolio, but a lot of people borrow against their homes. And those two things tend to suggest that the wealth effect is stronger in the housing market than it is in the stock market. So I think we've seen a very big decline in the stock market, but as I mentioned, the coincident measures of growth are still kind of hanging on. So most people haven't really been all that phased yet. If the declines spread through to the housing market, which I believe that they will, and I think that the early data suggests it already is, I think that's when you're going to see a larger negative impact from this wealth effect. So the fact that it hasn't, you know, people don't believe that their house is worth less yet is important, but there will be a point several months in the future where I think that it'll be readily apparent that homes are lower in value, and at that point, that should have a more negative impact on future consumption.
Okay, Eric, a few minutes to go. Let's move on to the question of inflation, because I think that's probably equally, if not more, pressing right now in the terms of the debate in the public square than growth. And how would you respond to the notion that, the relationship between growth and inflation is not necessarily fixed? It's not linear, it changes, depends on other variables. Jim Bianco, who is very articulate on this matter, is a friend, been in these rooms many times, has been making the argument that just as in the last decade, the market was overestimating the extent to which inflation would go up and interest rates would rise. In other words, inflation rates never manifested themselves to the extent expected. This time, as we're not living in Kansas anymore, Dorothy, it's going to be the other way around. Everyone's expecting if we get a slowdown, you're going to get inflation back to 2%. The great moderation will bring it back. But he makes the argument that because of we've run out of cheap labor, we've run out of cheap goods because of deglobalization, we've run out of cheap energy, that not that we're in Weimar, let's not get hyperbolic here, but instead, maybe inflation coming out of this after whatever slowdown we get, it's going to be, 3Z, 4Zs, not 2Zs.
Mm-hmm.
And the reason I bring this point up is it's very important in terms of how it might inform your opinion about interest rates and the bond market and bond prices. So, if I was to say to you the next 5 years or whatever? I mean, okay, yeah, we get a slight, yeah, we know inflation's coming down, Captain Obvious. Yeah, okay, we got that. Okay, but that's not the issue. The issue is how much does it come down? How quickly does it come down? And what's the inflation outlook likely to be for the next few years? I mean, if you just want to riff on that, there's a lot of meat on that bone. So have a go at it.
Yeah, yeah. I'll give my basic framework for how I think about inflation. So, I could debate Jim and go point for point on the labor issue and on demographics. Um, I understand the good heart theory that demographics are inflationary. I don't agree with it. I think it ignores the demand side of the equation. But I understand that argument. You hear people talk about onshoring. We can debate these points back and forth. No one really has any numbers to quantify these things. They're all narratives for the most part. Not saying that they're necessarily guaranteed to be wrong, but they're all narratives. My view on inflation is that inflation is a money price wage spiral. It's not a wage price spiral. That's what's in everyone's textbook, and that's the prevailing sentiment is that it's a wage price spiral, and if wages go up, then inflation becomes entrenched and it feeds on itself. That's an incorrect model of inflation. Inflation is more accurately defined by a money price wage spiral. So early in 2020, we had a very significant monetary acceleration. In the middle of 2020, prices started to rise. And then in late 2021 and early 2022 is when you started to see wages rise very sharply. So it's a money price wage spiral. Then the Fed continued to accelerate money, which allows that money price wage spiral to become entrenched. The Fed is in the process of reversing that spiral, so it works in reverse. So you have a major monetary deceleration right now. Prices are then going to fall. And we've seen that happen. We've seen commodity prices start to fall. We've seen asset prices fall. We've seen container rates fall. We've seen used car prices start to fall. All prices in the economy are starting to fall, reacting to the monetary restraint. Now, the Fed is well on their way to bringing the inflation rate down, but they have to sustain that negative money price wage spiral until it carries all the way through to wages, which normally will show up as a reduction in employment. So, to the extent that the Fed is able to hold this course, which I think will be complete sometime around Q1 23, they'll have sufficiently reversed this money price wage spiral. That doesn't mean that the core PCE is going to be 2% in Q1 2023, but because of the lags that we talked about at the beginning part of the call, they'll have sufficiently reversed the momentum in that money price wage spiral. However, right now we have a monetary deceleration. Prices are falling, but wages are still elevated. We haven't made it to that third part of the sequence yet. So if the Fed gives up this fight early, or there's fiscal and monetary coordination before we fully reverse the money price wage spiral, and you get a renewed monetary acceleration while the last part of the sequence, wages, is still elevated, then you're going to get that money price wage spiral going back in the upward direction. That would keep inflation elevated, and that would resemble something more similar to the 1970s scenario. But to the extent that the Fed refrains from monetary easing and there's not any fiscal coordination for the next several quarters here, given the magnitude of the monetary tightening that they're undergoing, in my view, they'll have sufficiently reversed that money price wage spiral. And then you could layer on your onshoring, your labor, your all of these factors. But if you stay contained within the money price wage spiral model, those factors become a little bit less important, because if you have a fixed pool of money, then the economy is going to
Listen,
have to adjust in size to that new level.
right. So, but let me ask. So that all makes sense. But let me ask you a slightly different question. Do you think the relationship between growth and inflation is stable?
I think it is, because the way that growth feeds on inflation is through excess capacity. So right now, the economy is rigged up to handle a certain number of capacity. Let's make the number up. Let's say capacity utilization is running at 80% globally. And the economy moves on unit volume. So real growth is unit volumes. And if the growth rate falls sharply, take a hyperbolic example, minus 50%. So the economy is moving 50% less units. That means that capacity utilization is going to fall dramatically. That means you're going to need less people on the production lines. That means you're going to need less trucks. That means you're going to need less truck drivers all the way through the supply chain. And what that reveals is excess capacity. So you have too many trucks. You have double the amount of trucks in the economy that you need. You have excess labor. Significant declines in growth almost always bring down inflation. The most extreme example would be recessions.
Yeah, no,
And
Eric, I get that. Let me say the question differently. I may make the question clear. Of course, growth accelerating, decelerating, all things being equal, which maybe they never are, is going to bring with it, more inflation, less inflation. I get that. But what I'm trying to get at is, let's just take energy as an example, all right, or labor. Just take energy. If we're in a world where the excess capacity, we're bumping up against production capacity limits for all the reasons we know. Each delta, each incremental percentage of growth is going to have a higher impact, higher inflationary impact if we're bumping up against oil supply limits than it would be going back, say, 20, 30 years ago, where there was, 15 or 20 million barrels a day of excess capacity lying around. So,
I understand where you're
yeah,
coming, but you're trying to make a macroeconomic forecast about the broad rate of inflation based on micro factors. And you're 100% correct to assume that what happens with the price of oil is extraordinarily important and influential to the overall inflation rate. But if we go back to macroeconomics and we take an aggregate supply and aggregate demand model, the only way that you can get a big stagflationary environment like the 70s is you have inwardly shifting supply, which I can be sympathetic to, and outwardly shifting demand. The demographics and debt situation is going to cause a persistent inward shift of demand, a
correct.
constant reduction in demand. So even if you have a constriction of supply and you have weakening aggregate demand, you'll end up with roughly the same price level, but a lower level of real growth. So in order to make a sustained inflationary case, you have to make a case for a constriction in supply, and that
Yeah.
fiscal and monetary policy will continue to support an outward shift in aggregate demand.
I guess
I don't, I don't, I
I
don't know if you. It's so that's not so. If the economy left on its own, given the debt and demographics, the structural forces, the aggregate demand curve shifting in will do a hell of a lot to contain the rate of inflation. However, if you want to make political prognostications about future fiscal and monetary coordination, which I don't have great insight on, you may be completely correct about what you see is coming, and if you are 100% set on the fact that we're going to get COVID part two stimulus at some point again in the future into constricted supply, then I mean inflation's gonna come roaring back,
Yeah,
no
yeah,
doubt
yeah.
about that.
Eric, listen, I know we're running up against a stop here, but let me just put it this way. You know, my father was a mathematician. I studied dismal science in college myself. And one of the problems I have with economics is, we try to model all this. It's a social science. We try to model like a physics equation, like somehow, the answer was handed down on Mount Sinai, and it doesn't work that way. I mean, just look ex post. Go back the last 10 years. Okay, forget about. I mean, I don't want to make prognostications about what might happen. I mean, your guess is as good as mine. But just take a look. Go back the last 10 years, 20 years. Okay, all the outsourcing, all the offshoring, tremendous increase in aggregate supply, which was one of the key factors in the Great Moderation, why are you able to run with relatively higher growth with low inflation. So I'm not talking about something which might happen. I'm pointing to you of something that already did happen, and I don't mean to be difficult, but I'm asking annoying questions because I don't. These are the things that bother me. I don't know the answer.
Right, but what also came with that extraordinary increase in aggregate supply, the increase in the labor pool, was the largest increase in demand for commodities ever through China real estate investment. So while you had this huge increase in aggregate supply and a big increase in the labor pool, people seemingly forget in that argument that China poured more concrete in 3 years than the US did in 100 years. What's
Right,
going to
but
happen
yeah,
with,
but
if that labor pool starts to fall because China's population is
sure.
deteriorating, and people say, well, that's going to be inflationary from the supply side. Well, what about the demand side of the equation and the secular rise in the price of copper and oil and cement and all these commodities that facilitated the largest boom in residential real estate the world's basically ever seen? So you're not
Right,
going to replicate that demand. So there's always a balance here. People suggest that because we're going to have less labor, we're going to have constant demand, that China's going to be able to replicate what they
sure.
did over the last 10 years going forward.
No, for sure. You make an excellent point. I mean, yeah, for things like cement and whatever, you're totally right. But on the flip side of it is, you go and you look at imported goods. Your Samsung TV or whatever fashion items you're getting from Malaysia or whatnot. I mean, huge. So yeah, it may of course it made the price of commodities go up more than would have been the case. But the flip side is there are a lot of products where you had a huge collapse in price owing to the increase in supply. So it's messy, and I guess I have more questions than I have answers. I guess is what I'm.
No, it sure is messy, and I don't make it. I'm not trying to make it out to be like I have the correct view here. I'm articulating
All
my,
right,
my
all
side
right,
of the view.
all right.
I wish I was able to argue a little bit longer, but I'm running up against my hard
All right,
stop
I'm
here.
going to ask you one last question. Then you're free to go. We've got a great room here. We're going to keep going. What's your variant? Do you have a big variant perception? If you look at what investors are thinking, what they're expecting. I mean, I know we've got Cantro in the audience. I want him to come up, but I'm in his camp that earnings are going to be a disaster in the next few quarters. And listening to you speak, where you're having the economy slowing, but wages stay sticky, sounds like a formula for a pretty big profits recession. So I don't know if I don't want to put words in your mouth, but do you believe that or something else? Or I guess put it this way: what's investable in your view, given whatever variant perception you might have?
Well, I believe that the economy is going to slow more abruptly than consensus believes. Everyone's sort of um, become complacent with this idea that the economy is going to glide lower, and if we have this recession, it's going to be mild. That's what I'm hearing now from people that didn't call a slowdown when it was developing. I believe the slowdown is going to be a little bit more abrupt in the way that it hits. I think it's going to hit sometime in the next 3 to 6 months. The coincident data, we've seen the slowdown in the earlier data. So I think what comes with that is a sharper decline in profits for sure. And I think that the investable part is it's difficult on the timing, but I believe that the level of interest rates that the Fed is raising to, which is going to be something like 4.75 or 5, if we go 12 months in the future, we're going to be a lot lower than that rate.
Eric, on that note, this has been phenomenal. I hope you'll come back again. This has been really terrific, and I'm speaking on behalf of all the audience. The fact that you came ready for game, you brought all your slides with you. I know people really like to be able to look at slides and data is terrific. So, Eric, I hope you'll come back again. I'm sorry you have to run, but this has been
No,
awesome.
I apologize, George. Thank you so
No
much,
worries.
and I will be in your next room for sure.
No worries. Thanks, Eric. Thanks so much.
Take care, everyone. Bye bye.
Wow, that was terrific. Okay, so let's get going here. We're gonna do RGFNJ first, and then Emma. RGFNJ, please unmute yourself.
Hi there. Thanks for taking my call. Question. I guess this is really probably a question for Eric, but maybe I missed something, and feel free to clock me if I did. But what I'm not hearing is like what happens if either we're at peak oil or energy prices don't come down. Like he does a brilliant job at um, projections from where we were. The question is if oil and nat gas is still, it keeps going up. Like the Saudis are squeezing our nads, and we're exporting a bunch of nat gas to Europe, and Europe is squeezed too. Similarly, by high nat gas prices. What does that do to inflation expectations? I didn't get that. I didn't see where that was factored in, but if I missed something, please feel free to tell me a new one. Thank you.
No, I think if you heard my question, I was asking a variation of that question. I think I specifically asked about energy, but also, is the relationship between growth and inflation always the same? And you mentioned energy. I also spoke about the big increase in aggregate supply from globalization. And what we aiming to get into was the labor market. The fact that labor participation rate maybe is going to be permanently lower. Who knows? So you're barking up the same tree I'm barking up, and unfortunately, Eric had to leave. But I'm totally with you on that question. I don't know, Emma. Did you have a thought on that, Emma?
Yeah, I'm with you, George. I just felt like I wanted to comment when he was saying that no to your question, because you could just have if you had a really extreme contraction in supply, say due to a natural gas problem, and where smelters and in all of Germany gets shut down, say, and you have this stable kind of small, like every year annual contraction in demand. Yes, you will get more inflation. Like to answer your question, that's just it. Do you follow me?
100%. That's why when I was making the observation that trying to solve this as one would a physics equation, it doesn't work that way. I mean, the problem is one has to make all these assumptions, ceteris paribus, all else equal. Well, things aren't all else equal. If we're running out of, if we're running up against production limitations for energy, if we are deglobalizing, so there's less stuff coming from China, and in fact, for onshoring, and all things being equal, that's increasing demand for labor. That also suggests something about the relationship between growth and wages. So 100%. I think RFG and Jay and Emma and myself are all kind of asking the same question. I wasn't. Maybe if Eric had more time, he could have given a more complete answer. But I think we're all asking basically the same question. So, AELB, you're pretty thoughtful on these matters. Did you have any thoughts on this?
Uh, well, to be quite fair, I think that the main reason why, I just wanted to follow up on what you said, George, because people, mainly the people in charge in central banks, they view economics as physics because they're mostly academics. Okay, so they think they can just plug in this formula, this model, and they're going to be able to figure out a solution. It doesn't work that way. This is a dynamic world. But yeah, that's all what I wanted to add.
100%. I don't know, maybe there's someone in the audience, Javier or Jeff or Cantor. I'm just looking at KFAB. You always got interesting things to say in this regard. Anyone else who wants to weigh in on this, please. But no, AELB, it's a great failing of the social sciences, and look how often the economics profession gets it wrong. And so these are the questions that bother me. I don't pretend to know the answer. I just am not satisfied with the answer. I know the question. I'm just not satisfied with the answers. Emma, did you want to say something again?
No, I was just agreeing with you. I mean, there's a lot of things going on right now that I just can't get good answers to. Where
100%.
historically you could, or somewhat good answers, I would think. But yeah.
100%. 100%. I mean, and then we had limited time, so there were other questions I wanted to get into. But for instance, question multiple time frames. So, yeah, I would agree with the notion that he makes that we have higher debt levels that can curtail your growth and therefore act as a restraint on inflation from a sort of long cycle standpoint. But from a short term perspective, shorter cycles, these dislocations can be kind of acute, and so it's a question of multiple time frames. And we didn't really have a chance to get into that, but that's one of the things that that I'm bothered by, and that importantly bears upon how long. For those who say, "Gee, the Fed's got to keep rates up and get rates up and keep them there," how long is it going to take for inflation to come down to the much hallowed 2% target level? There's good reason to think that it's going to take considerably longer than the consensus believes. And again, I go back to Jim Bianco's framing of the argument. He describes himself as an inflationista, again because the factors which gave us such disinflation have disappeared and now reversed. Cheap energy's gone, cheap labor's gone, goods from China are getting more expensive, et cetera, et cetera, et cetera. So, and he argues that they're going to keep rates up. Something's going to break. There'll be a financial accident, whatever. They'll have to ease, and maybe we'll wind up in a world where because we don't have as abundance of labor, imported goods, and energy to the extent we had before, the new normal inflation is going to be 3, 4, and not 2. And the relevance of that is you say to yourself, okay, well, is a 10-year treasury at 390 or wherever it is today, is that a good buy or not? And people look at TIPS yields and they try to calculate real rates. Well, who's to say the TIPS market's correct? So I don't know. It's very important how one answers this question. I love Eric. He's great. He's a tremendous thinker. I hope he comes back, but we could have a lot more fun discussing this. Javier, welcome. What's on your mind, my friend?
George, how are you, buddy? I wasn't going to speak. I'm a little under the weather, but I was just going to answer it. George, your question is, it's one I think about often. I went on the Fed's website, I don't know, 6-8 months ago, and I wrote down I think I counted 413 PhDs listed on their website. And you think, oh gosh, that's a lot of people. But then you go and look at what they're trying to balance, and you've got 300 trillion in global corporate debt. You've got 2.5 whatever it is quadrillion in derivatives held by banks. I mean, we've created a monster that's so far beyond what notional rational humans can comprehend, and it's a train, right? It's this giant train, and it's rolling down the tracks, and you've got these central banks that are in charge of adding a little bit of coal to the steam engine or applying the brakes, and that's somewhat what they're supposed to do. And it's this in like Aleb or Albi. I hear you talk all the time, and I think you're very smart, but I'm not very good at pronouncing things.
Yeah, Javi, I got to interrupt for 1 second. Albie, do you want to be called Albie or AELB? Because I trip on your name also.
My real name is Emin, if I just want to keep it simple.
Sorry, what did you? Emin? Okay, go ahead.
Okay,
go ahead.
So he's right. They're thinkers, right? So they think about this stuff really hard, but arguably some of them have probably had some sort of practical experience and some sort of, maybe they've worked at a bank or maybe they've whatever. It doesn't matter, right? So the question is whether or not they, can you keep the train from rolling too far downhill? Do you run it up the hill and you stop the train? You're looking at 400, 600, 800. Take the ECB and the different central banks, and you've got 1,000, 1,500 people who are thinking about quadrillions in derivatives and trillions in bonds, and all of it boils down to one thing, and that's real GDP growth, right? It is the real factors of the underlying economies around the world. And so they've goosed it, they've leveraged it, they have chopped it up, we've microed it. KFAB can come up here and talk about things none of us even know what they really are, because they're derivatives of derivatives of derivatives, and they're deltas on vols that trade on spreads. Like, we've created this microcosm of economics that basically makes the functionality of all of these things work. And at the end of the day, George, for me, it's really simple. Either we're on the right path, and everything's great, and the globe needs to continue to be up and to the right at all times. And who cares what the real numbers are? Because as long as I'm good and I can go, get my Starbucks and my Target orders, I don't care. What is, nobody cares what it's going to look like in 10 years or 15 years or 20 years at this point. So I step back. I like to look at it from what are they doing today? How do I trade it? If I get too moralistic about it, then it becomes this giant thought process. And so for me, if they're going to do the right thing, they're going to continue on the path, and they're going to put the brakes on the train, and they're going to let us get to a point where we can reset and think about things rationally. And George, tomorrow they could change their mind, and that's fine. I'll trade around it, and we move forward, and the bubbles get bigger. But and I keep saying it. Michael Cow talks about resonance, and he talks about the bridge, and eventually, when you get into these giant systems, you can't control the resonance. And I think we're starting to see what resonance looks like in an unhinged bubble.
Thanks for that, Hodge. Okay, so let's go to Cantro. Good to see you, man. How you doing?
Hey, George. How are you?
Awesome. I don't know how much of that you heard, but
Yeah.
you got some. So, any thoughts, comments, reactions?
Yeah, and well, I'd love to debate the inflation thing. I'm just coming home from a 4-day trip in a bunch of different cities, and don't have much brain bandwidth left. But just something I'll add. I think we're not going to be going back to the deflationary backdrop we've had for 15 years. And so the points that you made, if you think about the 80s, the relationship between I want to bring this to markets. The relationship between earnings and valuations in the 80s were positive because consumers were leveraging up and we had disinflation and lower interest rates. In the 90s, that continued because we had China start manufacturing everything, strong dollar. Consumers continued to lever up. So earnings went up, which was the biggest driver of the returns, while PEs were also going up. In the 2000s, we had this commodity boom, so you had an inverse relationship between earnings and valuations. We had a massive, I'm not sure what the exact number was, but I think earnings grew like 100% from in the 2000s, yet the market returns were only about 50%, right? Because you lost on the multiple compression because we had higher inflation. But that inflation was all in the form of commodities. The last 15 years, again, we've had a massive bull market, all due to, or mainly due to massive PE expansion. And again, we've had a positive relationship between earnings and PEs. The economy gets better, risks go down, PEs go up, earnings go up, rates stay low. So again, that positive correlation, those are the best periods for market returns. As we go forward, I think the outlook that you're kind of describing is a very strong inverse relationship between earnings and valuations, especially given that we've all been smacked across the face after 30 years of disinflation and the last 15 years of deflation types of backdrops, and now we're all going to be uber inflation sensitive going forward. When we hear stimulus, eventually we're going to get a recovery at some point. Markets will rip higher. And then very quickly, we're going to start to worry about inflation because of this current experience, right? Everyone was afraid to buy tech stocks after the blow up in tech, financial stocks after the blow up in financials. And they're going to be worried about, when they hear the word stimulus, we're going to think forward to what is that going to mean for inflation? So if we do have this tight supply dynamic, we're going to have a very strong inverse relationship between market valuations and earnings. And I don't want to say a zero-sum game, but again, if we have these issues, rates can't go up very much because of the debt issues. Growth can't be that strong because of the debt issues and because of tight supply and some of these commodity issues. I think it gives you a much more volatile market, a much more lower returns market, and a much more of a stock pickers market. So not good for passive investing.
Not good for Goldilocks, huh, Gatro?
Goldilocks is lost.
George, can I share something with you?
Please go for it. Yeah.
All right. I just wanted to give you a perfect example of the dislocation that the central bankers have in their mind. So, as you may know, the Bank of Canada yesterday raised the policy rate by 0.5%. Well, some people say they chickened out. Well, actually, no, they're just taking into consideration the fact that the private sector is very levered up. So I went through their monetary report, and they expect, so I quote, they expect inflation to be at 3% by the end of 23 and to hit 2% by 24, okay, without a recession. Now, the only way that you get to that level, a 3% inflation, given the current situation of fundamentals, is if the S&P is at 2,500. And you won't get that unless you have a severe recession. But at the same time, they still refuse or even accept to get the R word out of their mouth. I mean, the guy went into TV yesterday and he simply refused to get it out of his mouth. I'm telling you, these guys live in La La Land. They're totally disconnected from reality. Again, because they're pure academics.
So, I think you and I see pretty much eye to eye on a lot of things. So doesn't it make? Oh, good. K-Fab's coming. He's the smartest guy in the room on this stuff. Let me get him up here. Does it make you so? What we saw, saw in the UK. They had we never knew that UK pension funds were a thing until this whole thing came up a few weeks ago. Now you're describing what's going on in Canada. In Japan, they periodically intervene to stop the yen from going to zero, et cetera, et cetera, et cetera. So, I mean, have we kind of reached the limit? These guys are basically going to give in, as they always do. It just strikes me that they have no plan. They're just lurching from one crisis to the next. Whatever fire is burning most brightly, that's what they tend to. But their intellectual framework for dealing with this whole thing is just completely wrong. I mean, what would you say to that, Amit?
It's completely wrong. It's completely wrong because I mean, I've had the opportunity to meet some of them. I mean, and I can tell you that these guys have no practical experience whatsoever. This is why. I mean, they're straight out of school, straight to the desk, and they get to work on their papers and their charts. I mean, they never traded or invested or anything of this sort.
Yep. All right, so we've got a lot of sharp cookies here. We're going to do K-Fab and Gnostic and then David. K-Fab, good to see you. What do you think of my friend?
Hey, George. So obviously I can't speak for Eric, but I think we pray at the same church, so to speak. So I think your criticisms on the modeling side are 100% valid. But what I would challenge you to how to think about it, at least it's how I've learned to think about it, is they're using Newtonian physics, meaning that that has its applications in the world, but they're trying to apply it to a nonlinear situation. So as I've mentioned on prior rooms, the framework I think that's applicable is the Bachian one, which is self-organizing criticality. So that is a branch of physics, but they're not in the right neighborhood, so to speak, on the physics side. So from an inflation perspective, I think that a lot of what Eric said I agree with, because I think there's a sorry, call. I agree with a lot of it because I think there's a lack of patience relative to these cycle calls, and as he rightly pointed out, the normal lagged effects of what happens as the cycle rolls over, where you get these 6 to 12 month lags in inflation that lags the. I'm sorry, George. I'm going to have to take that. It's my son calling twice.
Yep. All right, tell you what, K-Fab, why don't you come back when you can? Let's go to Gnostic and then David. Hey, Gnostic, what's on your mind?
I really like that space. I like what he said. I tried to bring Deer in because I thought Deer would have much more intelligent comments than me, and I'm waiting for K-Fab to get back. But the one thing that stood out to me that was sort of hidden in the rest of his comments was that the effects of the inflation or the interest rate increases seems to be having an accelerating effect on bringing about a recession. And that's something that I really wanted to sit down and ask him as to what that's happening. And some people have tangentially touched on the accelerating process in several of their comments. And I found that very interesting.
When you say accelerating effect, are you referring specifically to the impact on the interest sensitive parts of the economy? What are you referring to?
Yes.
Yeah. So
in the chart that he put up, the interest rates, and he even commented that the interest rates seem to be having an accelerating effect on bringing about the recession on the interest sensitive parts of the economy, which I'm not sure, again, and the academics dealing in the Fed, I'm not sure they actually understand that you've got two sets of the economy, the interest sensitive ones, the non-interest rate sensitive ones, the lag in there, and the difference between the two seems to be getting bigger and bigger in the response to interest rates. So I'm seeing a kind of bifurcated economy that I sort of scratch my head on and say, how much damage are we going to do before they actually recognize that they brought about the recession?
So, Gnostic, it's T-ball time. You just put the ball on the tee for Cantro. He's coming out of the dugout again. Cantro, take it away.
Yeah, well, the unique thing about this is, number one, excuse me, the Fed started tightening at the peak of the profit cycle, which means that banks also stopped easing. So we have a condition today that I can't think of a time we've ever had. Most Fed tightening cycles, 5 out of the last 7, occurred while the economy was accelerating, where PMIs were low and going up, just like 2016, 17, 18. So that means that banks were easing lending standards. Today, we've got a combo of higher interest rates and tighter lending standards. That usually doesn't happen. Usually by now, the Fed's easing or not doing anything. And one of the reasons there is that lag of about 18 months between a Fed tightening cycle and a slowdown is because, again, historically, the banks are usually easing while the Fed's tightening. This time, they're compounding each other. And so I think that could be part of it that we're seeing today. That has never happened. And then adding to that, think of food and energy inflation. Right? There's 3 things that have preceded every single recession: Fed tightening cycle, big spike in food and energy inflation, and tightening lending standards. And so we've got all 3 of those today. And think about the food and energy inflation spike we've just had, which is now down, hit as high as 22%, the second highest in history. That's effectively the Fed funds rate going up for low-income people, right? Where the basket of consumptions for food and energy is 40%, to 50% of their consumption basket. So, that was the reason I would argue that we initially started to slow down this year on a global basis, because we had a huge rise in commodity prices, gasoline and oil. And that, the biggest problem in the middle of the year was not interest rates for the economy, for the consumer. Now that is, but back then it was oil, it was gasoline prices. So you're hitting low income, and now the lagged effect of higher interest rates and tighter lending standards compounding each other at the same time is
Hey, Cantro, you're in a bad place. Emma, can you hear him?
I cannot, no.
No. Hey, Cantro, can you come back when you get to a better place? We're having a hard time hearing you. Well, hopefully, it'll come back. Hey, KFAB, you're back. Can you speak? Please unmute yourself.
Yeah. Apologies. Had to address something with my son. So yeah, the point I was trying to make is that the sequencing of all of this stuff just takes time in a normal cycle. And we're dealing with some really weird stuff given the effects of the pandemic stimulus, the distortions of, changing consumption patterns. And then all of that was accelerated with this global supply chains with the invasion in Ukraine. So, and the financial war that was declared after that. So it's just made it a real big mess from a navigation from a cycle perspective, in my judgment. And so everything that Eric was saying as far as the timeline, those are all kind of normal for cycles. I think what's making this one a lot more complicated and confusing is the 2 negative GDP prints in the first half of the year, stuff like that, understandably is confusing people. But as he pointed out, production and employment just haven't rolled over yet. They're going to. And once that happens, that's the key point that he raised that I think will start to hit the inflation side of the equation more abruptly. And again, it'll take time, is as nominal GDP starts to roll over. So what opened up is a deflation gap, meaning that the spike in prices, because a lot of it had to do with supply and demand shift and the global supply chain issues, it crushed demand. So demand has now dropped off. You're seeing that in inventories, bloating in retail, that type of stuff. And that creates this gap, demand destruction, and that kind of leads the way towards prices falling. And that's going to then feed through the python, as I've been saying, through the service sector and all these other things in the next 12 to 18 months. It just takes time. I think the big optionality here is, and I think that's really the most important part of all of this, which is eventually they are going to come back with, and this is my opinion, they are going to come back with pandemic 2.0 on the stimulus side, because the monetary stimulus is going to be relatively ineffectual. And that's going to mean, reignition. And it's the question, and I think Eric set up that that dynamic very well, which is if they do that before they've kind of renormalized the growth in the monetary side of things, at the ODL, other deposit liabilities, if they get that back down, and as he mentioned, sometime probably late Q1 into early Q2, then you're not reigniting this the way Volcker did in 1980, for example, and that Powell's talking about. He doesn't want to commit that same quote unquote mistake as he perceives it anyway. So I think there's some risk that they'll reignite it anyway, just because the size of the potential fiscal stimulus that might be coming down. I mean, these maniacs have been spending like drunken sailors in the middle of the biggest cost of living crisis in 40 years. So imagine what's going to happen when all of this stuff kind of rolls through the python in 6 to 12 months, and unemployment spiking, and where nominal GDP falling potentially at that point. So, I mean, I think that unleashes all of these things potentially in kind of a nonlinear way relative to your points on energy and all these commodity issues on a secular basis.
So, K-Fab, let me pour gasoline on your fire, no pun intended, and this is also for Cantro. So the world you're talking about, let's bring it back to markets, because we can talk about, I think Jerome Powell. Hi, this is K-Fab from Pennsylvania. I'm a first-time caller. I don't like the Federal Reserve. I mean, no, we're here to make money. Okay. So what you're describing, we're in a world where, weeks in eternity, and where's the recession? Where's the recession? This number's better, that number's worse. Atlanta Fed nowcast is okay, blah, 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 blah. Where's the recession? Where's the big earnings collapse? Okay, we all get impatient, right? What you're describing, K-Fab, though, I don't want any words in your mouth, but it sounds to me like it's kind of like when you're eating or if you're drinking. The whole idea of you should stop eating when you're not hungry as opposed to when you're full, because there's a time lag, whatever, it's 20, 30 minutes between the time you've had enough and you're full. Or if you're drinking, it takes a while for it to really hit you. So are you suggesting we're kind of in that middle period where you've had enough to drink or had enough to eat, but it hasn't really hit you yet? And when it hits you, boy, is it going to be a doozy? Is that kind of, and if you don't like my metaphor, come up with your own, but that's what it sounds like to me. What would you say?
Yeah, I think Mike's been on this. He's nailed it, which is basically what we've had up until now is more tantamount to a mid-cycle slowdown. The way the markets have reacted, markets haven't, outside of the bond market, I'm talking about risk markets, have been acting as if this is just a slowdown, and up until now it has been. What they're going to start pricing in is that this is turning into a recession, and that's where the earnings drop. So as Mike's been saying, it's been a rate story up until now. And that to me, I think of that in terms of slowdown, like you had in 18, 19, like you had in 15, 16, where the growth rate of the economy downshifts, but you avoid recession. That's basically, for the most part, how things have been behaving. And I think the collapse in some of the bubble stocks, the ARC names, I think have kind of clouded some of that because they've dropped so much, understandably, given where they were on a valuation basis. But if you look at kind of just the guts of the economy, it's been a slowdown up until now. I think that's going to change. And to your point, George, I think it's going to change probably very severely. And that the downside risks on the E side, and that's to me the big part of this, is that the PE in the market, the P was a bubble, but the E was a bubble too. And markets have not been pricing that in, and that the downside and the earnings side of the equation are, just enormous.
Cantro's avatar, he's got a great smile. He's a handsome guy, but I think his smile just got bigger. So Cantro, back to you. T-ball time. Go for it.
Yeah, I'm driving home, and I got about T-minus 7 minutes until I get home from being away for 5 days. So, yeah, 1,000%. So, I'll try to summarize quickly the original question. Part of the reason things seem like they're slowing quicker, it's having a bigger effect. Right, we had the big stay-at-home bubble, and so we had all this excess inventory, and all the demand for all that stuff, Wayfair, Peloton, all that kind of stuff dried up. So that's part of the story. But the second thing, and I don't know what I said earlier, if it came across clear. Can you hear me now? Just making sure you can hear me.
Like a Sprint commercial. Yeah, we can hear you now, Cantro. Okay. Go for it.
So the Fed started tightening here. So historically, people will say, well, when the Fed hikes, the markets go up. That's because most Fed tightening cycles, start when the economy is actually accelerating. okay, like 2016, 17, and 18. That's not the case this time. So the Fed's raising rates, and at the same time the economy's slowing. That means they're raising rates at the same time banks are tightening lending standards. I can't not think of a time where that's happened. So not only are rates going up, but fewer and fewer people are going to be able to even get the rates that are out there. We'll get the fourth quarter senior loan officer survey any day now for Q4, and given that the U.S. PMIs have continued to slow, which is what explains that, I'm guessing we're going to see even more tightening. And then on top of that, we've had it, and I think really to why we've slowed down. I agree with KFAB. It's been mostly a slowdown. It's been the lower income people that have gotten crushed. Why? Because gasoline and food and gasoline and inflation went to 22%, the second highest in history. All of this has happened again, and think of that as the Fed funds rate going up for low income folks, right? Because they're not rate sensitive. They're food and energy sensitive. That's 40, 30, 50% of their consumption basket. And those three things have preceded every single recession. So the reason I think people are saying, why isn't the recession here? Why isn't the recession here? Why are earnings so good? We've had this conversation, I feel like every month, George, you and I and everyone else, is because people are looking at the stock market and January and the downturn year to date is saying, well, we're pricing in a recession. No, as KFAB said, the majority of the downturn all of the downturn up until June was PE compression due to higher rates. Now it's becoming a mix. And we're seeing forward earnings estimates start to drip really, really quick. In June, next year's estimate was 251. Today it's 236. My view is that by year end, we're going to be at 230. I think that's too high. And not that I think earnings next year are going to be 230, but again, I'm trying to figure out where consensus is going to go, how long it's going to go down. And everything the Fed has done only has touched housing. And, it's global. This is, again, the broadest, deepest tightening cycle in history. So, yeah, it came on slow, and then it came on fast, and this downturn's coming on slow, and then it's going to come on fast. Next year's, where really shit hits the fan.
KFAB, go. Cantro, go be with your family. We'll catch you again in the next space. Really good.
All right, take care, everyone. Good night.
Take care, Cantro. Okay, let's go now to.
If I may add, George, because
go for it. Yep.
Yeah, because a lot of people, again, are optimistic about earnings. I just want to post some numbers. So I've got the 2018 fiscal deficit numbers in front of me. So we have a deficit of $1 trillion in 2019, a deficit of $3 trillion in 2020, a deficit of, again, almost $3 trillion in 21, and 1.4 in 2022. Anybody telling me that you have less, you're going to have as much income running into the economy this year or in 23, just like 21, is just lunatic. That has yet to materialize in the real economy. This is what is going to affect earnings.
Thanks. You and I see completely eye to eye on that. We always talk about the public sector debt surplus and the private sector public sector deficit, public sector surplus or deficit. Got that, but talk much. Public sector deficit and private sector surplus, 100%. So between asset prices collapsing, rates going up, and taking away the fiscal stimulus are a large part of it. Like, how don't you get a recession? 100%. Okay, let's move on here. Let's go to. Bliss and then David. Bliss, the floor is yours.
Hey, George, great space. I completely agree. I think we're all trying to figure out if the markets are going down, another 20% here, or if potentially there's a possibility that they've actually bottomed and start to turn around, and data continues to be strange. KFAB touched on the stimulus. I kind of wanted to talk that a little bit and just kind of put a question out there to people. Obviously, I agree with all the data that Eric put out there in terms of the negative macro numbers coming in. But I think the stimulus that we saw in 20 and 21 is very unique and something that we haven't ever seen before, because even in 08, the stimulus was mostly pushed out through the banks. It didn't go out through PPP, and we didn't have massive dollars going into the economy in the way that it did in the last year or two. And so with that, I guess I'm wondering, is it potentially possible that, in terms of Fed speak, that they are able to maneuver a soft landing in terms of really just blowing all the excess off, bring things in. Potentially we see inflation stabilize starting in October, because if you look at numbers last year, inflation really started rising in October. So if it stays the same as it's been just the last few months, we potentially can see a 1% drop going into next month. Fed starts to stabilize rates, hold it steady. Is it possible, given some of these things, that potentially they can maneuver a soft landing? Would love to hear people's thoughts on that.
Yeah, I'll have a whack at it first, and then KFib, I don't know if you want to have a go at it. But listen, anything's possible. I think it's extremely unlikely. I think there's only been one example. KFab will correct me. There's either been none or only one example where it's very unusual to have a soft landing. And, given that rates, let me back up. It's almost an identity. In order to crack inflationary expectations, to bring wage gains down, inflationary pressures. And again, inflation is a process. It's not an event. It's a question about forward expectations. In order to do that, you have to crush the corporate sector. You have to hit the corporate sector's earnings so that they stop trying to hire people. A feature of this cycle has been it's very difficult to attract and retain people. You still have a situation where, if you look at the gap between what people who are quitting their job, the wage gains that they're securing, versus those who are staying, it's like at an all-time record high. Don't hold me to this, but I remember seeing it a few weeks ago from Jim Bianco. I think it was like 6.5%, 7% for people leaving their jobs, and I don't know, 4.9% for people staying at their jobs. So the way you reduce the demand for labor is you've got to hit the corporate sector. You have to hit earnings. If you don't hit earnings, there's no reason for these guys to stop bidding up the cost of labor. It's identity. And so therefore, it's almost like we must sacrifice corporate earnings on the altar in order to get inflation down. So you can't have one without the other. Yeah, I guess anything's possible, but I just think it's extremely unlikely. I'm sure KFab has a much more eloquent thought about this. KFab, you want to have a crack at it?
So to take some opinion out of it, if you just look at objective leading indicators, because Lakshman Achuthan, who you had on in August, made a public appearance this week, and he relayed that their long leading indicator, which forecasts out 2 quarters, so we're talking about getting out into late Q1 into Q2 next year, is already right now basically and this is for the global economy, where it was at the depths of the global financial crisis. Okay, so to me that means that we're already on a glide path for a significant global recession, and that the question now becomes, if central banks continue to do what they're doing, how much of the left tail does that open up? Because we haven't even had shocks yet. We haven't had anything major blow up, as far like a Lehman Brothers, or the UK pension system was like the first little tremor potentially. So that opens up the left tail, that if we get some of those kind of shocks, or one or more of them, that you could get something even worse on a global basis in the business cycle than what we had in 08. And I've talked about this before, George, about how in 08 we had the shock absorbers of China and India and some of the emerging markets that were actually still growing at a healthy clip, and we simply do not have that right now. That's why the global leading indicator is actually worse on a glide path right now potentially than what they were in 08, even, is because of that synchronicity. So talking about the soft landing to me at this point is kind of game over. It's the recession's already baked in the cake. It's a question of how severe it is, how long it is, and how much of that left tail risk potentially gets realized.
KFab for the win, as usual. Appreciate it. That's awesome, man. Okay, so we're going to do David, and then Jake Russell, and then Nice Guy. David?
And thank you very much, George. And by virtue of this potential attack on capital earnings in that sense, the big question now is the passive investor outflow that we might see, considering 40% of passive investors on aggregate are now integrated and are participating within our market. I think that in that Walter Deemer idea, we haven't seen a true dramatic action in that sense. And the market has been quite apathetic. And in theory, with increase in unemployment and this redemption in, let's say, employee compensation packages and the selling of, let's say, stocks because of the need of capital for expense, I think that this creates a potential like increase of index outflow in that sense.
Totally logical, David, and completely agree with you. And I'm patiently been waiting. I think that day will come. And when retail goes to sell, I don't know who's going to be buying. So excellent observation, David. Appreciate it. Let's go to Jake and then Nice Guy. Jake, please unmute yourself.
Thanks, George. Appreciate it. My question is, with the increased financialization of historically non-financialized assets, and now you got this more intertwined international kind of monetary system where everybody is so deeply intertwined, is there a corresponding increase in reflexivity, where basically now every move the Fed makes in one way, we're seeing a much more dramatic shift? And it seems like if that's the case, then when they decide to pivot, then maybe it's not a soft landing, but maybe it's a very fast landing, and maybe you just go straight down and straight back up. Just curious, like how the increased interconnectedness maybe impacts that reflexivity, or like the impact of certain actions.
I can take that, George, if you're okay with that.
Go for it. Go for it.
Yeah, so again, this is that Bachian physics that I mentioned earlier. This is the self-organizing criticality, the complex systems lens to view economics and markets. And so that interconnectedness creates more unstable conditions. So it can be faster, particularly in financial markets, because of the leverage and the hidden interdependencies, and all of these things that seem to kind of come out of nowhere once the stuff starts to hit the fan. So that's the market side. The economic side has a lot of the same principles, but it's all relative thing, right? So the economy's still the Titanic. Could the Titanic turn a lot faster than normal? Probably, but it's still a big ass boat that takes a while to turn, even if it's doing it twice the normal rate. So that's how I would kind of think about it. Is the market sure as heck could be entering a period of just crazy volatility. That's kind of my expectation as we get into the teeth of markets pricing in the recession. And that, I think that could blow the doors off of people as far as how volatile it could get in both directions, by the way. But the economic side of it, like I said, it's just, even if it's going to be a lot faster than normal, it's still going to probably be, slower than people think in this dopamine world.
Appreciate that, KFAB. The other thing I'd like to add, it's not just the speed or the size of the decline that's relevant. It's what comes after, as opposed to the last 10, 20 years, whatever. The Fed's always been there with more liquidity, serve up another round of drinks. So it's always bailing out markets. I think given the inflation dynamics we have and the fact that real rates, I do not believe are ever going to go back to where they were before. I won't say ever, it's a strong word. Unlikely to go back to where they were before. It's not just markets are likely to go down, in my opinion. I'm accused of being a perma bear. But I think they're going to stay down. I think recovery is going to be far more muted. You think about this bull market's been fueled by, surging profits for all the reasons we know. Big fiscal programs, shift in rents from labor to capital, declining oil prices, et cetera, et cetera. So earnings are going the wrong way. On top of that, valuation. And if you go from if real rates are going to be higher in the future than they were in the past, combined with slower growth, combined with a rather inadequate outlook for profit margins, I think looking at a lost decade is I don't want to say it's a kind expectation, but let's put it this way: I wouldn't be holding my breath looking for outsized returns. I mean, if you look at work from GMO or AQR or John Hussman or the more thoughtful, serious people on this matter, they all come to the same place. Now, the perma bulls, the CNBC crowd, will say, well, I'm a perma bear and so on, the folks I just mentioned. I think not. I think I'm a realist. So it's not just how hard, how quickly, how fast are things going to go down, but how long are they stay down. I'm talking about markets now, because we're really here to try to figure out markets. We all have opinions, but as I always say, they're your beliefs and is your portfolio. So it's not a good environment for risk assets. Okay, I think I lost track here. Who's next? Was it Jake or Nice Guy?
I'm happy to go, George, if that's okay.
Yeah, go for it, Nice Guy.
Great, thank you. And I'm a big fan of the spaces, George, and everyone. So thank you for this. My question is, what do you say to someone who says, "Yeah, I agree, a lot of bad news, recession coming, but the crash, quote unquote, isn't happening yet"? And I think of guys like they're maybe less fundamental oriented, like Jeff Hirsch. You had him on the spaces a couple months ago, I think. Best 6 months. We could have a rally. Before the final the final death blow. What do you say to someone who points to that type of analysis, or do you not put any weight into that?
Well, I have to be careful what I say because as everyone's probably aware, I've had a rather auspicious beginning with the ETF that I launched. That being said, counter trend rallies are a feature, not a bug. For those of you that have been in these rooms since the turn of the year, have been consistently bearish the whole way down. We had a good counter trend rally. What was it, off the June lows, and we did it again in August, and we've done it now for the last couple of weeks. But in bear markets, there really are no winners. I mean, he who wins is he who loses the least. So yeah, counter trend rally, sure. I'm the wrong guy to ask. I didn't get this counter trend rally right. I got the big picture right, but didn't get its counter trend rally right. So yeah, but the question is, what do you have more confidence in? The extent to which the probability and extent to which the market could rally in the short term versus the potential downside and the probability associated with that downside. It's all about expected return. And I guess where I think, my conviction, we're playing for small upside with unknown potential. I mean, you put your own probability on whether you want to hit 50-50 or whatever, versus very high conviction, in my view, that the S&P is easily going below 3,000 within the next few months. So I come out on the side of, trying to play to the upsides of fool's errand, but that's just my opinion.
Right. Makes sense.
Hope that answers your question.
Yes, it does. Thank you, George.
I'll just add something real quick, George. So there's been two periods in history when we've been on the precipice of a recession, just any recession, and that was 1927 and coming out of World War II. And I'd argue actually that, and what happened in 1927 was interesting because, the market basically just blew right through the recession, and the Fed pivoted and inflated the ultimate peak in 1929, and the market just kept going. And I'd actually argue that technical recession that we had in 2020 actually is a very analogous to 1927. We got quote unquote technical bear market in amplitude and decline, but that was like a 4-week correction basically that happened to go over 20%, and we basically blew right through everything else. And for the most part, we didn't get the normal kind of recessionary impacts. And the post World War II thing is just not analogous at all. The situations are completely different, for all the obvious reasons. So, I mean, is it possible? Anything's possible, obviously, but when you've reached this point in the business cycle, like we've seen with earnings this week, when stuff really starts to roll over on the profit side, and you've got inverted yield curves and stuff starts breaking, these counter trend moves tend to get shorter in duration until there's at least some degree of intermediate term capitulation. And I don't think there's been much. We had a bit of that in June, but we really haven't had many signs of any capitulation since June. So that's, I would say that you're looking more in like the 2 to 3 week counter trend rallies are kind of normal in this environment until we get that kind of intermediate term bottom.
Thanks, KFAB. The other thing I would just add to that, I mean, people will point to how the internal peak in the market wasn't December of last year. It was really February of 21, because that was when some of the most hyper liquidity sensitive assets peaked out. SPACs, loss-making technology companies, et cetera, et cetera. And so they go for the lead scouts first. They pick off the guys who are most sensitive to liquidity first, and then it starts to percolate into the market infrastructure. And now you're coming for the generals, the big guys. So to KFAB's point, you're taking down Microsoft or Amazon, or today, I guess Apple wasn't down that much, but they're having a demand problem. I mean, it's starting to get real. So so in KFAB, going back to the point discussing earlier about, was the Hemingway line, how you go back up slowly and then suddenly. I think we're kind of reaching that phase right now. So anyway, all right, let's move ahead. We're going to go now to Josh. Josh, please unmute yourself.
Hey, George, I appreciate it, man. Thank you very much. Quick question, George. I wanted to ask you about the bond market, man. Lately, I noticed this last few days. I look at the bond, and man, these people right now is bouncing from the bond, and I look at the yield also right now going a little pushing down. So you think, Fed? Fed started buying something, because I look at their balance sheet also. I don't see balance sheet growing. So maybe what could be the reason, like, yield is going down and the bond is pushing back up? Any idea?
Yeah, I don't pretend to have the answer to that. I'm going to defer to KFAB, but I'll just throw a couple things at you because I've thought about this as well. There has been some talk, and KFAB counts these numbers pretty carefully, but forgetting about the size of the Fed balance sheet, which has been coming down at a glacial pace, you got Ms. Yellen with the Treasury TGA account, and there's been some speculation that they may be messing around with that again. The other side of it is there's a growing view, I'm not saying it's right or it's wrong. Some people have the view that the Fed's done enough, and it's only a question of time before we slip into a proper recession. And in that scenario, going to recession, interest rates will come down, bond prices will go up. So I don't know what the answer is. I try to focus on the what, not so much the why. Jake, did you have an answer to that? I think I saw you raise your hand, Jake.
No, absolutely not. Just another question for KFAB whenever.
Yeah, just hold that.
I got the following question once. If you
hold on. Let me just Ahmed or Emma or KFAB. Either any of you have a question, an answer to Josh's question?
Yes, I'm actually of the opinion that the main reason why you see this is this drop in yields. I mean, it's mainly because of foreign money. Foreign money is parking money in the U.S. because it's. George, I don't know if I can say. I'm just gonna say unkosher words, but it's a shit show outside of the United States. Literally, it's a shit show. So people with assets, with cyclical assets, are just liquidating them. Okay, liquidating for dollars, and they're parking the money in the U.S. because it's viewed as a safe haven.
But where can I see that? If they're parking the money, where can I see that? I'm looking at the repo facility, which is FEMA, and I cannot find it anywhere. I can look at their balance sheet.
I think he's referring to them to foreigners, like foreign life insurance companies, for instance, the big Japanese life insurers buying up in the treasury market, which then reduces our overall bond yield.
Got it. Let me ask you if anybody can jump in, because right now we have a situation where we have a bigger situation in globally financial crisis, right? So now, I mean, in a situation where we can't even pivot, Fed cannot pivot, but the market is expecting from the Fed to pivot, right? And then another situation where we have is where something's supposed to break. If we break, do you think the Fed is really wanting to break something? If that breaks, what level we are thinking, and what level we could go into the breaking something? Because market, everybody think market is our equity market, which is not that as big as the bond market, but to save the bond market, we are right now sustaining the equity market. But equity market looks like right now is behind. Like we always say, market is ahead of 6 months and stuff like that, priced in and all. But man, I feel like market is way behind. Looking at the second quarter earning of S&P 500, and if you compare with 2018 and 2019, operating income of S&P 500 was 39, 38, 35, and we are right now here. The second quarter EPS, I look at it of the S&P 500 or 500 companies, is they are calculating right now is like 47, 45, maybe 40, 46, 40, 47. So that means we are still, based on what I look at everyday balance sheet of all the earnings of the company, they coming out way lower. And plus the forecast guidance they're coming out, they look like we are very close to 39 now. S&P 500 of, if you look at the third quarter of the S&P 500
Right. So,
started coming.
Josh, is there a question, please? Because you're kind of
Yeah.
going on.
So yeah.
What's the
So
question, please?
so
What's the question?
so if that is happening, then what exactly going to happen to the S&P 500? We all know that it's going to heading 300, but where exactly is going to break? What exactly is the Fed going to do?
Well, listen, they're stuck between a rock and a hard place. Jerome Powell's the man without a plan. On the one hand, they need to tighten financial conditions to slow the economy, to break the inflation. On the other hand, there's the issue of breaking markets, breaking financial institutions. The question is which comes first and what are they going to do? As I said, I think he's the man without a plan. I've used this example many times. It's like a driver going down an icy covered mountain road, going from one side of the road to the other. He's about to hit the guardrail on one side. So, oops, quick, put the wheel back to the other side. So we go from one extreme of needing to fight inflation to the other. Oh my God, some institutions going to get in real trouble. The interesting thing is so far that so far, if you look at credit spreads, they're pretty well behaved. I mean, they've gone up some, but they're not at panic levels. And so I think okay. So outside the U.S., you had the UK pension plan. Look, I am sure there are going to be more institutions that are going to get in trouble here. As Dennis Gartman always says, there's never just one cockroach. But we have to see which, stay with the metaphors, which fish float to the surface. And so, whether it was the Japanese yen spiraling out of control, the yen got to 152 a week and a half ago, or the UK pension system going insolvent. So there are these constraints, or these binding constraints. So on the one hand, they're having to deal with inflation. On the other hand, they've got the problem of what happens if you cause a financial accident. By the way, I would not describe. I can't remember who coined this phrase, but I thought it was brilliant. S&P 2500. S&P 2500 is not systemic risk. What's different is the real risk has been shifted from the balance sheets of the banks because of all the legislative changes we made in the wake of the great financial crisis. The risk has really been put on the portfolios of people's 401k program, 401k plans, their pension funds, private equity firms, endowments, et cetera, et cetera. So S&P 500, S&P 2500 is not a systemic risk, and so I think we're going much lower for all the reasons you were alluding to. Emma, you raised your hand, Emma.
Yeah, for anybody who probably a lot of you know about this, and I'm wondering why the Treasury had to do this. But this whole 6 months, you can buy Treasuries with a 9.62% yield. This is offered to retail too. I read it in the Wall Street Journal today and tried to get my hands on it. It broke the website, but it's down because everybody's trying to buy these things for 6 months. 9.62%, can't beat it. Why are they doing that? Any ideas?
Are you talking about those $10,000 plans that you can put money into?
I think so. I don't know. I know what the max
Yeah,
is.
They're I
There's a
bonds.
limit on it. It's only $10,000.
yeah, yeah.
Their
So
their I bonds for per Social Security number are limited, I think.
yeah, and it's not a big deal. It's not worth talking about.
Are they
All
just
right,
doing it to help consumers or something like that?
I don't know. I mean, as KFAB was saying, there's a $10,000 limit.
It was basically when they rolled out tips in the late 90s, they added this I bond as a tip version of savings bonds, basically. And we haven't had CPI go up at all for the entire 22-year period. So no one even knew about them for the most part. And now, because of CPI finally going up in the last 2 years, people are becoming aware of them.
Thank you.
Okay, let's go now to Bobby. Please unmute yourself.
Hey George, thanks. This is in reply to Josh's first question regarding the bond. I think the big story here, and we can't forget, is bonds. The way they're acting throughout for all countries around the world. Looking at they bond yields have gone parabolic. Yeah, I mean, the word pivot has come up as of late. You see even BlackRock coming out today saying that when Fed comes out November 2nd, they're gonna bring up pivot. People got to realize that bond yields just went up so fast that until this bond situation normalizes, until currencies normalize, the story's not over yet. This is the big story here. If this is if we really did peak in yields, then sure, I would feel a lot more comfortable. But the problem I'm seeing here is the story is not over. Until this stabilizes, we are over levered, not just in the U.S., in the euro bond market, in the euro market throughout the world. This is a global deleveraging. Any single basis point up is going to hurt, because it's not going to just hurt U.S. and their over leveraged balance sheets, private equity who went in and bought all these single family. No, we're talking about on a global level. This is dollar denominated debt. 80% of global trade is in dollars. Every basis point that ticks up, that's an extra layer of interest expense. And then they have to go and convert to dollars, and their currency is depreciating 10, 20, 30, 40, 50%. Until this story normalizes, that's the big picture. So Josh is absolutely right with that question. Why are we it's a cool off. We're just seeing bond yields cool off right now. We're just seeing currencies cool off right now. This is going to resume up. They're gonna raise. One last point. The Fed doesn't control the long yield. They can control up to 7, 10, but after that, that is all supply and demand. ALB makes a point. If you listen to Jeff Snyder, he follows U.S. Treasury purchases very closely. He has been saying that he does believe that there are foreigners who are coming in and they're buying long duration bonds, and I do believe it. I think it's a decent buy, but you have to realize anyone outside the U.S. is losing money on their currency. They're losing money in their markets. They're losing money everywhere. So now they're going to go and buy. The only way they can access stable capital flows is if they go and buy a 30-year 4% yield. Now, where I think people also are missing the mark is if bond yields continue to go up, well, not only are they losing money at exchange, but they're also going to start to lose money on their bond value. They have nowhere to hide because they are outside the U.S. dollar system. We fortunately own the global reserve currency, but they don't. They can't go and print like the Fed can. So at the end of the day, the U.S. Treasuries are the risk-free asset of the world simply because we have such strong infrastructure. And as the Fed raises, I look at this as an economic weapon. We have wars overseas. We have OPEC and countries who are commodity based, who are cutting supply for whatever reason. they're creating demand destruction. They're creating not just demand destruction in the U.S. I always tell people, all the pain that we as in the U.S. feel, it's always multiplied outside the U.S. So if we have, 5 times pain, we have whatever pain we have is multiplied by 5, 10, 20, 30 times outside the U.S. So people need to realize that. So every
Yeah.
single basis point that they go up, if they do a full 75, it's game over in my opinion. The story's already written. George is right. This market is going down fast. All this data that we're looking at is lagging. We're seeing the best possible earnings we're gonna see for the next at least a year. This is Apple just released earnings, only down 2% after hours. Amazon down 20%. Facebook down 25%. They lost 25% of their
Right.
value within
Yeah,
6 months. Yeah. All right. That's it.
yeah,
Yep.
Bob, you make a great point, though. I mean, you're right. The U.S. 10-year is, the risk asset, but yet look at how volatility is spiraling out of control, and the markets become disorderly. And so you think about that. That's the collateral for everything else. It does not bode well for risk assets. But again, I'm accused of being a perma bear. David, do you have a follow up? David, please unmute yourself.
Yeah, specifically the chart that I posted 2 days ago was illustrative of the 10-year and the 10-year gilts at that point. And we saw a potential, like a point where either the relation is going to continue or essentially it's going to follow suit with the 10-year gilt. And I think it's an interesting mentality that Raghuram Rajan brought into play in 2005, in the sense that how has financial developments made the markets more risky, in the sense of like credit spreading and institutional players in the standardization of certain asset holdings. And if we're looking at the confirmation of essentially Credit Suisse and the pension gilt system currently, it's essentially saying that the world has a standardized potentiality of liquidity at this point, or a liquidity crisis at this point, I should say. And it's trading in relations to that. And I think that that's where it becomes really interesting to study. Sorry about that.
Thanks, David. I mean, another way of looking at all this, think about it. And I've used this analogy before. I apologize for you, or you're sick of hearing me say this, but it's like you keep a beach ball below the surface of the water, and you keep it suppressed, and you keep it there, keep it there, keep it there forever and ever and ever. And then you let go, and the ball rises up to the surface and shoots up above the surface. Well, that's what they've done with interest rates. They've done it for years. And they could get away with it because inflation wasn't a problem. Now inflation is a problem. And so what people are recoiling in horror about is the fact that rates have they've gone up a lot and they've moved so quickly. But what's anomalous is not where rates are now. It's where rates were before. We're not going back to that world again. And if you accept that view, and then you stop and think, okay, I now have to use this new cost of capital, and I plug that in to value junk bonds, equities, private equity, et cetera, et cetera, et cetera. Valuations collapse up and down the waterfront. This is the new normal. That was a dream. Ankit, you got a question? Please unmute yourself.
Yes, I wanted to ask that we all know that the only way the government is going to deal with this crisis is inflate its way out of this, because deflation is unacceptable to the normal public. So my question is, what is the end game? Because something important is happening in the background. Demographic decline is taking place since household formations are being delayed. Young people do not want to form families. So at some point there'll be a turning point, right? So will it be something like social unrest, reset of the monetary system, central bank digital currency controlling taxation and household spending? What is the end game?
Ankit, you were very articulate. You very nicely laying out the possibilities. I don't know. I would just say there's so many ways to lose, and none of this is priced in. Again, focus on the what, not the why. If someone had said, just go in the Wayback Machine 2 months ago, and someone said, oh, someone somewhere is going to blow up because of what's happened to the rise in interest rates. I don't think anyone would have guessed UK pension funds. So in similar fashion, trying to guess where it's going to break next, I don't think it's impossible. But more importantly, it's not important. We can just say, though, there are a lot of pressure points, and the idea that none of these are going to break, that is an extremely unlikely scenario. So thank you for the question. Hey, Neely, good to see you. Please unmute yourself.
Hey,
What's up, Neely?
George. I'm finding myself in the beautiful side of Boise, Idaho today as I head out to the Hillsdale Free Market Forum. I'm pretty pumped about that. But unrelated to that, me hanging out with a bunch of academic economists, you know, the point about the household formation, I get a little like slightly, not triggered, not in that sort of way, but the data's out there that people are actually having babies again. So like wedding, like bridal jewelry sales in the United States at the largest jeweler, not a stock call here, right? Just pointing out empirical, observable behaviors in consumer. As you know, I study the consumer economy. I mean, bridal jewelry sales were up like 45%, like spiking. Like it's never, ever been that high before in 2021. People literally put a ring on it. They're absolutely getting married. Like anecdotally, it was the busiest wedding season of every makeup artist person I know, every photographer, every wedding event venue. Like I actually think millennials are in fact coupling officially, and I think that they have been buying houses up until this point. There's this broader sense of, you know, parents are actually stepping in to help them buy homes. We think that's a little bit of like a financial currency to keep the grandkids nearby because retirements are also up. I mean, I'm with you on the Encantro and, you know, Kayfabe and Emma and others, right, on this is like, we still haven't even really seen kind of the damage of what we've done to the economy. But the one bright long-term hope I will hang on to, because I am pessimistic and optimistic at the same time, is household formation is very vibrant. It's real. And it is on the other side of whatever it is we have to kind of suffer through on the recession. So I'm a little bit more longer term optimistic, but shorter term, very pessimistic.
Thanks for that, Neely. Question. Without giving away any secrets, just sort of generically, what is your sense of the pace of the consumer in recent weeks? Downshifting, upshifting, more of the same, or is it really a question of which particular subsector you're looking at? Anything noteworthy to report in consumer land?
I think the you know, Amazon is interesting. I think there has been this broader conversation around services kind of outpacing now goods. Last year was goods, this year services coming back online. And the consumer does have to make a choice, right? Because their overall capacity to spend is in fact in check because of the inflationary pressures that exist. Now, services is big; it's a bigger component than the goods component of PCE. So I'm sure people will see, you know, PCE numbers and, you know, count it as like some big success situation, but because services is just simply larger, and that's where the mix is. I guess where we're still remaining a little cautious is you are getting pockets still of kind of underperformance, and Amazon is a pretty decent, you know, recent example of that on their forward guidance for the quarter. And I think it's very interesting when you think about it. You know, Jeff Bezos was out there literally days after they finished their Prime sale and for the fall Prime sale, and, you know, kind of saying, hey, it's time to batten down the hatches. You know, a timing of that sort of commentary we took note of when he made that comment. Clearly, he would probably know what trends were, et cetera. I thought it was a little bold for him to do that, but whatever, in quiet period. And, you know, so I do think that Amazon is emblematic of it. And, you know, it's funny because you have like folks like Bank of America, you know, kind of saying like, oh, we've seen, you know, no slowdown in consumer, or American Express, which of course over indexes to the upper income in terms of their client base and what have you, you know, everything's just fine and rosy. They were saying that all last summer as well, when Walmart Macmillan was out there just saying, yeah, people are having to choose between food and like rent. Okay. I mean, so I think that's just emblematic of like, there is a tale of two consumers right now. When will it hurt potentially the upper income consumer? I think one or two things. I'm in that camp similar to what was stated earlier around, the wealth effect dynamic on the markets is a little bit different than the wealth effect on houses. I think as people actually start to feel that their house price might not be as up and to the right as they had previously thought, while, by the way, their local governments are going to slap huge delayed property tax bills on them, I think there's going to be a little bit of a micro revolt on consumption as that happens and comes to bear. Of course, that's an annual event to the consumer on the property tax side. The other thing we're really curious about is what's going to happen with big kind of health insurance. Enrollment is right about now. That's a once a year kind of price sticker shock situation that affects anybody who is accessing healthcare, which is the vast majority of the United States of America has to do that, either private pay or they have to go through their corporate employer. Health insurance on the CPI was up only 1% or so, like 1.7% in January last year. George, it was like up 28% or something. I mean, it was huge jump. It's been growing every single month. And so clearly a corporate purchased health plan can kind of mitigate some of that cost, but it's still going to be higher. And it's a sticker shock when you have to see that, or the deductible goes higher to kind of balance it out or something to that effect. So we're a little concerned about like how that might also just influence people's moods heading into holiday as open enrollment.
Neil, let me ask you, what are you hearing from C-suite execs about hiring plans and prospective wage increases? Because obviously rising labor costs has been, is a big problem. Do you sense any diminution in hiring intentions, or do you think wage gains are still going to prove to be pretty sticky?
That's a really good question, and I don't have a great answer for you that's going to be soul satisfying. I will say that I do detect that boardrooms and C-suites are kind of exasperated because they kind of don't know what to do with this standoff, the stalemate, right, between the need to employ people or fill roles and then, not having qualified candidates. And there's nothing more probably soul sucking than actually having to like go through a whole batch of, resumes of people who are totally not qualified to do the job you need them to do. And that's probably what's going on. In fact, I know that's what's going on. So we have a little bit of a stalemate on that kind of mismatch. Here's what's not being said, but it's a strong hypothesis as to how we head into 23. At some point you just go, all right, well, if demand slows, we're going to have to address, you think of Intel, announcing $10 billion of cost savings, right? That's not a lot of, I would suspect, that's not a lot of, like a lot of little cuts, around the entire organization. That's like, what divisions are we cutting? Right? I mean, it's that sort of reevaluation that has to go underway. And so I think we're going to see more restructurings. And I think you're going to see, if we can't solve it, if we can't support it in a way that makes sense, it won't be productive. And ultimately, CEOs have to answer to the boards, a couple times a year. So I would imagine we're going to see task automations, restructurings, kind of rethinking whole like product lines and more of that sort of way that we could start to see layoffs, et cetera. Not just kind of a death by 1,000 cuts sort of layoffs. So we'll see. We'll see how that rolls.
Last question, Neil, as long as I got you. I think, well, I'll speak for myself. I don't want to speak for others. But for those of us that think we're going to see a real slowdown in housing, it's already happening. And that the outlook for housing looks pretty bad for the foreseeable future. And yeah, I get if people aren't going to move, they're going to fix up their house. I get all that nonsense. Okay, but forget about it. Okay, net, this is not going to be a good thing for anything in the housing food chain or supply chain. I don't want to mention individual names. So it's not about, what do you think of Home Depot? What do you think of Lowe's or Floor & Decor or whatever? But just, I think Mohawk Industries blew up today. But just generally companies that are somehow tied to the housing food chain, the housing supply chain. You think that's going to be a problematic area?
I think it'll probably be mixed, would be my gut. Because maybe think about, here, let me give you a framework back, okay, for perspective. perhaps the framework is no longer what goes into a new home build, right? And that was just all rising tides lifting all boats in the chain. It's okay, well, what is related to nesting within this home? Because I think there could be an argument being made, especially if we do see where I started and why I even came up. I'm sorry, I took that to be a question for me from George. George, am I still good? Do you want me to?
Yeah, no, go ahead, Neely. Someone just
Okay.
jumped in. Go ahead.
Okay. So, I think you have to have this framework of what was actually tied to the ecosystem of that new build versus what's actually emblematic of a process of nesting, right, within your home and what have you. And that can probably breed kind of different answers as it relates to consumer behavior, because I do think that there's going to be a nesting dynamic that happens as people do continue to form those households, as we see both in the engagement to marriage sort of process. You are seeing birth rates positive again in the CDC provisional data. No one's writing about it. It kind of shocks me, to be candid, because it's actually pretty optimistic. You'd think they'd want some sort of positive news cycle, but people are having babies again, and what does that mean? So I think that people would want to maybe update some of the baby room or something to that. So I think there's a nesting versus new home sort of thing that could be differentiated in that framework.
Hey, Neely, so when you say birth rates are positive again, last I looked it up, they were 1.7 in the U.S. What is it? I don't get like that updated data, so I don't know if you could have.
It's buried in the CDC Wonder data. I can probably try to. I think I've tweeted it at some point. But there's
I'll look on your timeline.
Yeah, there's a monthly CDC provisional birth rate data that gets sent out on a quarterly basis on a hindsight view on a just 1 year at a time until they update it on an annual. It's buried in the CDC Wonder database, but it's there.
Thanks for that. Let's see. All right, I think we've been going at this for over 2 hours. This has been a tremendous room. Amit or Emma, David, anything else you want to say? Otherwise, I think we're going to close the room.
I just thank you very much, George, for hosting again a marvelous space, and I look forward to the following spaces as well. And to conclude my point, I think if you look at the 10-year gilt and the 10-year treasury right now, the relation still remains strong for now, and I think that we might see a potential breakage in that.
Okay, thanks.
George, can I say one last thing? It was on your point. If you go and look at the historical chart of a federal fund rate, from 1955 to 1980s, you see Fed fund rate peaks in the 80s, and after that, go and look. We're making newer lows. We're making newer lows, and the problem is because of the leverage in the system, sensitivity to interest rates. It's ultra sensitive because of the mass size of global debt. So I think right now we're seeing an anomaly. This right here is a monetary tool the Fed is using. At some point, they are going to have to, in my opinion, they're going to have to reduce rates just to be able to handle the leverage in the system. So overall, I do think rates go down, but unfortunately, because of the colossal liquidity event that's going through the world, remember, as the dollar gets stronger, sovereigns tend to sell U.S. treasuries to raise dollars. So I think it's still going to exacerbate the system, and we're going to see a further sell-off in bonds, which will make yields go up. So that's just my opinion.
Thanks, Bobby. Appreciate it. All right, ladies and gentlemen, another great space. We'll do it again. Thank all of you, Emma, Neely, Amit,
thanks, George.
Bobby, everyone. This has been good. We'll do it again before too long. It's really wonderful, and we'll be posting a recording tonight. Thanks so much. Good night, everyone. Take care. Bye-bye.
Bye, guys.
Thank you.